We're going to be talking taxes today. We're going to be talking about year-end taxes and what we should be thinking about for 2026. I will have the Q&A box that is at the bottom of your screen. So I'm going to be using that feature. So if you have questions, I'll try to get to them as best I can with the time we have allotted. We have, I think, the hour blocked out. So thank you guys for taking some time and spending your afternoon with me and chatting what's everyone's favorite topic, taxes. So we'll make it a good use of your time. There's a lot going on. And so there's certainly a lot of things that we here at the firm want to make sure that you're aware of as we're kind of getting towards the end of the year. So let's get started here. Make sure that I am sharing my screen the right way. So I want to share the screen here. All right. Hey, John. Hey, good to see you. Thanks for joining, buddy. Hey, can everybody see my screen okay? If I can just get one person just to comment in the Q&A, just to make sure. John, thank you. Appreciate you. Okay, cool. So again, thanks, Will. You know why we're here. We're going to be talking about tax planning as we get towards the tail end of the year. We only have effectively, 2 more months left in the year. We're getting to that time of wrapping up our taxes. And so certainly if you're a client of Bogart Wealth, you're probably hearing a lot of that from your advisors as we look at implementing, whatever your tax planning strategy is going to be. And then how do we set ourselves up for the following year? Here is a nicer picture of me than how I look today. I'll be leading the presentation today. If this is your first time here with me, my name is Brian Windsor. I'm one of the lead advisors here at Bogart Wealth. 19 years in the financial services industry. I've spent my career with 3 firms at Rowe Price, Fidelity, and I've been at Bogart Wealth for about 3.5 years for now. Really great place for me personally and professionally. Really that modeling of the integration of the tax piece, the tax planning portion to the not only the financial planning and the investment strategies, but that hybrid is really what's allowing me and a lot of our clients to find a better way of living a richer life. If this is your first time hearing about Bogart Wealth, I know our business development team is out there. We certainly are looking to help educate the clients or educate the population and their families really on how they can integrate their employee benefit plans to all the different offerings that are available in their benefits packages. Firm was founded back in 2016. We'll be celebrating our 10-year anniversary next year. Really excited about that. But we're headquartered in McLean. That's usually where I am. I live right down the street, luckily, so it wasn't too far for me to get back home. But I think the most important thing for me, if you're looking at Bogart Wealth and what it is, I mentioned that hybrid, sort of the integration of the tax planning, tax prep, along with the financial planning, along with the investment management to integrate all of that. What's really working well for us is that integration, but it's also due to our clients. It's due to the community that we continuously build with a lot of large companies and their benefit packages. So right now, about 1,400 households look to us as their primary financial advisor. And we take that very seriously, and we're always open to exploring how we can help other colleagues, friends, families, and so forth. I'm one of 50 great employees, so it's not just me, it's not just James Bogart leading the charge. There's a whole team behind Bogart Wealth. We have multi-departments that focus on our planning, our taxes, our investment strategies, our marketing, you name it. Very well-rounded, just a really, really, really solid firm. Okay, so let's lay the ground rules. What are we going to be talking about today? I think first, it's important for us to hit the biggest news out there. And what we're going to do is cover the new big, beautiful bill that Congress passed a few months ago. And so what we're going to do is talk about, well, what does this mean? And there's so many little nuances towards this. We're going to define what some of them are, what's retroactive for 2025 and what doesn't start until next year. It's not all easy. So we're going to kind of walk through step by step what we think are the three biggest things in the new tax bill. We'll cover the employee benefits plans, right? Making sure we understand the ability to save and the ways we can save. And how do we get a little clever with that with our tax planning? How can we, work with what we got in order to, effectively, make sure that we're spending our money in the right way and just not, overspending. We'll talk a little bit about charitable giving, mandatory withdrawals. Oof, favorite topic. I was just talking to a client about that earlier today, projecting how, for some of us, it's that year that we're required to take money out. It's getting closer. It's getting closer and closer. So talking a little bit about that, and then, what's 26 and beyond mean? Okay. You feel good, right? We're about to get started. It is October 22nd. It's my 9-year anniversary. And according to my wife, that means it's the EarPods anniversary. I didn't know that. I didn't know it was the AirPods anniversary, but I was reminded that that's the case. So I guess, times change. All right. We mentioned we're going to jump into the One Big Beautiful Bill Act. Let's talk about what was expected to happen, and we'll talk about what it is now. So if we remember, in the first Trump administration, back when Paul Ryan was head of the House, they passed the Tax Cuts and Jobs Act of 2017. Effectively, what that did was lowered tax brackets for the majority of individuals out there. It pulled down the 28% bracket down to 24. It pulled down the 25 down to the 22. Some things that, it increased the standard deductions for most people. That was nice. For some that were itemizing, they didn't like it. Because what's happened over the last decade almost is that we've seen that state and local tax deduction capped at $10,000. Before then, it was unlimited, right? You could itemize. And so what was expected to happen, that was just that the Tax Cuts and Jobs Act was a temporary thing. That wasn't supposed to be like a permanent law. And they were really what was happening. We were going to go at the end of this year and starting in 2026. In 2026, we would be reverting back to the 2016 tax code adjusted for inflation. And so this is like huge, because if you've sat with us, client of Bogart Wealth, hey, thanks for joining us. Thanks for supporting. But you've seen the financial plans that we create. And in that, when we do the tax calculations, we've always assumed for the majority of clients that we would go back to the old tax bill. And so what that means is, again, that remember we just mentioned that 28 to 24, and we were expecting all that to happen. So for the majority of our clients, we've been preparing for 2026 and beyond to generally be higher taxes on our clients. But what the new tax code that is now implemented, now it is permanent law that we're in the same tax brackets extended until Congress makes changes. So, this is pretty big stuff, because I think about that 24% tax bracket where, currently right now it goes up to like 390,000, 395,000, something around there. It was expected to not only go down to the 28, but then it was supposed to collapse to about 303,000. So now what you're talking about is another like $100,000 of income. It's allowing us to project more room within certain tax brackets and maybe we didn't have at our fingertips before. So this is where the planning gets interesting. And we'll talk about the benefits of planning. And, if you haven't done one with us in a while, or, you haven't even sat with us to do a plan, let us know, because these are important things as we're projecting long term. Okay. I rambled on about that, but that is, to me, probably the biggest thing long term when it comes to managing and looking at your wealth and tax situation. The standard deductions, they made those permanent. They also increased them a little bit. So this is retroactive for this year. So if you are still doing that standard deduction, great. We get even a little bit more relief increased. Now, if you're under 65, 31,500, and then if you're filing single, at 15,750. Okay. One other thing, as I'm on this slide, a lot of talk on the campaign trail last year. Mary, I'm hitting this right now. Yeah. On the campaign trail, there was a lot of talk about no taxation for Social Security. That is not in this bill. 900 some pages. There's no changes on how Social Security is being taxed. What they have done is pass what's called the enhanced senior deduction. This doesn't mean anything about Social Security. You could be taking Social Security or you could not be taking Social Security. If you're over the age of 65, and I'm assuming, let's just assuming that you're married filing jointly, and and you're over the age of 65, if your adjusted gross income is less than $150,000 or less, whether you're itemizing or whether you're doing the standard deduction, you can do an additional $6,000 deduction, not credit, but deduction off of your taxes. So that's in addition to the standard or the itemized. This phases out if your adjusted gross income married filing jointly goes between 150,000 to 250. It lowers 6 cents on the dollar. So that $6,000 steadily goes down as your adjusted gross income goes up. So depending if your income is between 150 and 250, you're going to get something. Over 250, nada. And this is per person. So if you are a married couple and both of you are over the age of 65, both of you would be entitled to the $6,000 each, so $12,000. But here's the thing: this isn't permanent. This is not something that is something we can go home and hang our hats on and say, like, this is going to be the law of the land. Because as of right now, we only got this for 4 more years. This is supposed to sunset in 2028. That could always change, right? We'll wait and see it. But again, this isn't something that's going to be permanent. So when it comes time to thinking about your tax plan, it's okay. Well, I know I can't count on this being there. Should I be thinking about keeping my income lower in these next few years so I can take advantage of this? And at what benefit does that give you, not in the short term, but also does it make sense in the long run? These are the questions that we can help answer for you. I mentioned that SALT, limited to $10,000. This was like really contentious, guys, when it came time for the Republicans, specifically in the House, to pass this bill. This was something that I think they wanted to do a lot quicker. But I think really what happened is it really picked up a lot of steam where it was supposed to be done by a certain time, and then they finally got it over the goal line. But the contentious part was what to do about this SALT deduction, the state and local tax deduction. There was Republicans in the House in purple districts that were saying, we need more relief. But then you had others in more deep southern red territories that were saying, well, what message does that send? And so the compromise was to raise the state and local tax deduction. Now, this is for 2025. This is not a 2026 and beyond thing. This is for 2025, where they raised it to $40,000, up to $500K of income. Like the enhanced senior deduction, as you go above $500K up to $600K, it goes down. So if your adjusted gross income is above $600K, you are still limited to the $10,000 state and local tax deduction. So there's that cap, $40,000 to from $500 to $600,000, so 40 cents on the dollar. Okay, so that's nice, right? So that's making clients rethink some things a little bit when it comes time for 2025 taxes, where maybe certain things haven't been coming into play when it comes time to taking deductions. I'm thinking about charitable deductions, where if we're thinking about making changes, well, oh gosh, if I'm going to have to, if I really want to be charitably inclined, Brian, and I want to have some benefits as well, like I'd have to be really giving a lot, and that's just not something that I'm really comfortable with, and do I feel like I have the funds to do it? It might be a little bit of a different story now, where if you are itemizing, I'm going to throw a wrench into this in a second, by the way, but if you are itemizing, you might get some additional tax relief. So that's where you can see be reduced over the threshold. And then, okay, yeah. So this sunsets back in 2030. So this is only law of the land for a few more years as well. So this is going to sunset as well in a couple of years. So again, thinking about our short-term tax plan versus our long-term tax plan, do we need to be thinking about focusing more on itemization, and how does that impact the long-term future? Knowing that this is for now what may happen, meaning we go back to that pretty small SALT deduction. The great question. I just saw that, Mary. It is 75. So if you're talking about on the enhanced senior deduction, I said married filing joint was from 150 to 250. It is 75,000 to 175 for single. I mentioned I'm going to throw a little wrench into that discussion on itemization and charitable discussions. How do Roth conversions affect? Well, I mean, so great question from one of my favorites. How does Roth conversion income affect these deductions? Income is income. So if we're saying that, well, what's going to happen if I start converting more and that pushes me above 500K, that will then have a sort of a double tax, where not only is it the additional tax that you're paying on the conversion, but it's also a tax because you may be losing some of the itemization. We'll talk about that. I certainly have things to show you about that. Okay, the wrench here is what's coming if you do itemize next year. But first, starting next year, there's the additional deduction for charitable contributions. $1,000 for individuals, $2,000 for joint. This is regardless if you are itemizing or doing the standard deduction. So a little bit of relief here. This is helpful for those people that are filing standard that usually don't get any support for charitable donations. They can start seeing some support here because, hey, I'm charitably inclined. I never really get a benefit, but if I donate $1,000 or $2,000, I get that in addition to my standard deduction. Not bad. But next year, it's going to start impacting the itemized deductors. Because for the first time, now the IRS is saying there's a floor before you can start getting a benefit. A floor for charitable deductions. So that means that the charitable deduction has to exceed what exceeds 0.5% of your adjusted gross income. That's the floor. So very simplistically, let's just say you make $200,000. Your first $1,000 to charity, you are not able to itemize that as the deduction. That's your floor. So anything above that, okay, cool. That can go. That can go. But it's just what's above that. Now, you don't technically lose that $1,000 contribution. You can carry that forward to following years. That's great. but it basically creates a drag. It creates a drag where, let's just say you do, you know, if you only do 1,000 every single year, that first year you're not getting a benefit, and then the following years you are, again, assuming your income stays consistent. So it's weird. It's just weird creating a floor for that, but that's what's happening. So those are, I think, the three biggest things that we've seen in the new tax bill. Again, it's the tax rates and how they're staying the same. The state and local taxes being raised for those less than 500K, and then the charitable contributions. Let's transition here. Let's talk about the employer-sponsored plan. So these are understanding. This is the understanding of making sure that I'm getting the maximum benefit of what is able for me and my savings rates, and making sure that I understand how maybe there's more I can put in different sources. Let's see. Another question: how does the contribution impact charitable giving limit? I haven't seen any changes to donor advised funds. I haven't seen any changes in the new tax bill about changes to that. All right. So for those that are still working, 2025, your defined contribution plans like your 401s, 403bs, $23,500. That is a combination of pre-tax or Roth source. If you have multiple jobs, that can only be the aggregate of what you personally put in. If you're over the age of 50, another $7,500 that you can put in. Then if you add up between what you're able to put in and your employer, $70,000 is the maximum that you can put in. For those over 50, again, there's that additional $7,500. So that's the max that can go in between you and your employer. That becomes important when we start talking about some of the neat techniques that your employer-sponsored plan might have available for you at getting some more money into your plan. So that's the layout of the workplace plans. 529s, the college savings plans, absolutely. For those that have kids, grandkids, if they have if grandparents can provide any sort of benefits. I believe the FAFSA, the federal student aid, doesn't look at what grandparents have saved for kids, where parents are looked at as far as grant money and such things. So I'm a big champion of that. Many states have their own 529 plans. The benefits, if you are considering, I want to get set up with my kids or grandkids, if you are in a state that pays income taxes, you may look towards your state-specific custodian, because if you do, they may provide you a state tax deduction in addition to, can you put in the money and it grows tax-free to get tax-free withdrawals for college? Super huge benefit, by the way. But you also get some smaller, possible benefits with some state tax deductions. And then you see you can front load it. The maximum you can put in is $19,000 a year. That's just the annual gift tax. So mom and dad, that can be added to each other. So that's $38,000 a married couple can give into a 529. But if you want to front load it, you can. You put a bunch of money up front. Basically, it's 5 years up front, and then you just can't contribute for a few more years thereafter. I don't know many people that are front loading it that way. But hey, could work. Could work. Rounding out benefit plans. If you have a high deductible plan, your health savings account, you can put money in before taxes. It grows tax-free. And guess what? If you withdraw it, when you withdraw it for necessary medical expenses, it's also tax-free. Triple tax-free. Absolutely. This is something to look into. And some of these HSA accounts, you can be tied to an investment. So if you don't use all of this money or don't need it all right, you can get generally some tax-free growth for the future, specifically as health care costs rise for us. So if you're an individual, 4,300 families, and the family plan can go up to 8,550. And then if you're over the age of 55, not 50, but 55, you can do the additional $1,000. Flexible spending accounts, you see those as well. You can go up to about $3,300 per year. If you're also married, you can do it, double that for your spouse. If you have these accounts, you generally have to spend it most by the end of the year. Most employers allow like a grace period of 1 or 2 months. I remember at a time I had a company and FSA account, and I, December 31st went to CVS and bought just a lot of unnecessary things. But if I didn't use it, I was going to lose it. Let's see here. I got a tax question that came in that says, given the higher standard deductions with the big beautiful bill and determining if one is in the 0% long-term cap gains bracket, does one simply look at the taxable income one has? And if that has a figure lower than 0%, then the gain they've harvested is it? Yeah, basically. I mean, they define the limits for next year, but this year is right around 90,000, 92,000, something like that. Yeah. If income is less than that number after deductions, yeah, absolutely. So there is some work. There's additional work that you can work in that 0% cap gains bracket for those over 65. Good point. Okay, I think we're doing good, guys. I think we're doing good. Mary, coming back to you. Great questions. Are contributions deductible on taxes? I think I said that it's yes on, well, it's possible. So if you live in Texas or Florida, you don't have any state income taxes, so you don't got to worry about it. I live in Virginia. We got 3 kids. We have the Virginia plan. When we put money in that, we do get money off of our state income taxes. It's just off the state income taxes. And that's based off of, what the plan allows us to put in and what the maximum deduction is. So it's a small amount, but it's still a benefit. It does not give you a benefit to deduct off of your federal taxes. Gift tax exclusion, does that benefit the receiver, the gifter, or both? Yeah. So the way it works as far as gifts go, that if I'm gifting money to any individual, I can gift $19,000 from one to that other person. So married filing jointly, we can do $38,000 to that one person. That person receiving it does not pay any sort of gift taxes. The person giving it, because it's under that amount, does not pay anything. If you give more than that, then you're supposed to file that as a gift tax, and that is taxable to the gifter, not the giftee, the person receiving the gift. The person receiving the gift, they don't pay anything for that. I love this group. This group is great. All right. So we defined some of the workplace contributions. I mentioned to you guys a little bit ago about, okay, there's that maximum of $23,500 if we're under the age of 50, another $7,500 if we're over 50. But between me and my employer, the maximum that we can do is either $70,000 or $77,000. But between what I'm able to put in and what my company matches, that doesn't get me there. It doesn't get me to that amount. So depending upon your workplace plan, your employer plan, not everyone's the same. I know a lot of my friends here on the in the chat or in the seminar, they have a workplace plan that allows a lot of flexibility. So if you're not sure, reach out to us. Let us know. We're happy to investigate and look at this for you. But what this is called is that, there's some excess money that I can still put in, between what I'm putting in and my company match. Maybe it's only getting me to $40,000 or such. A lot of times, we can, in addition to that, after we max out, we can put what's called an after-tax contribution. Sometimes it's called a spillover amount, but another way of saving monies into your workplace plan. These are after-tax monies. I'm getting taxed on it. It's not going into a Roth source. So yes, I'm putting money in addition to the maximum, but I'm not getting any tax benefit up front. I'm not getting any deductions. And the earnings that are on this money are going to grow tax deferred. Well, that's nice up front where I'm not going to be paying money on taxes. Might not necessarily be the nicest thing on the back end, depending upon what my financial plan says, what my long-term tax bracket says, where that could just lead to maybe a lot more taxes in the future. But what you may be able to do is let's call this mega backdoor Roth conversion, where I'm putting money in this after-tax money into my 401k. And what I'm doing shortly thereafter is that I'm just moving that over before I get growth on that money. I'm moving it over into my Roth source. Some employers do this for you automatically. Others, you have to contact them and contact the record keeper or go to their website, and you can, effectively put after-tax monies in and maybe convert them to a Roth without any taxes. Kind of a loophole, right? When it comes to 401ks, that you're able to do it, but you just have to put the after-tax money in first. To see this in action, here's a good friend of mine, $235,000 compensation. They have a 7% company match. They're putting in about 10% into their pre-tax. Once that's getting them to max out. In addition to that, they're putting a 5% after-tax contribution, and then they're also maxing out their catch-up. So between, if you look on the right-hand side here, guys, you can see the limitations that you can use an HSA. You just need to have a high deductible plan in order to have an HSA. Back to contribution. So this person, you can see between what they put in and what their company put in. Again, even this special after-tax source, it's still $59,200. Well, remember I said you can go up to $77,500 if you're over the age of 50. Obviously, this person's over 50 because they're throwing another $7,500 to it. So another way that you can, effectively save more money into your workplace plan and kind of push more money to the Roth. Why is Roth so critical and important? Well, because it grows tax-free. You don't have minimum distributions associated with it. So it's not going to be added to that big tax snowball that might come your way. And also when your kids get it, they get 10 years tax-free growth with that money as well as, withdrawals completely tax-free. So could be a lot of benefits if you're not sure. If this is something I should look into, I got a good company for you to call. I know some good people at Bogart Wealth. I'd be happy to put this together. But in this case, that $59,200 between what I and my company put in is lower than the $77,500 that I said is the maximum. So theoretically, if my company allows it, and some of our companies do, you can call the record keeper and say, hey, I want to make a special contribution. I want to make a special contribution to my account where basically you're writing a check into your 401k. In this case, $18,300 could be the maximum. There might be some restrictions on what they let you to put in, but very rough, very, very, very crude example, but gives us some ideas to understand that, hey, there's some after-tax money in there I could do some conversions with. There's some special contributions I can do to funnel more money in there. This is a huge tax planning technique because it allows you effectively to move more money into a source that's not going to be adding more taxes onto your plate in the future. Yeah, I'm not going to get any benefits today from any sort of tax deductions, but for a lot of us, when we look at the time value of money, it can be a big difference. It can be a big difference in their plan. Another example of sort of how that looks, going from the money into the 401k and then immediately rolled out to a Roth IRA. Yep. So it's not the fire alarm going off, but I'm guessing an Amazon delivery driver that's setting off one of my two alarms. The other one's not sure if she wants to bark yet. Okay, that's fine. We keep going. Here on your screen is where you're going to see. I hope you guys can hear this. This is great. Ordinary income brackets for 2025. And this is basically moving forward. This is just going to increase with inflation over time. So expect, year over year, this is the rule of law now, and this is how it's going to work over time. If you're filing single, the 22% tax bracket goes up to 103. So that's your marginal bracket. Your average tax rate is about 17.1, and the 24 goes up to 197, and the 32 up to 250. Married filing jointly. This was the big one I was talking about. So this year, that 24% goes up, is still up to 394, and it goes up for inflation next year. This was supposed to go down. To like $303,000. So this is the law of the land. This is staying as is. And so this is giving us a lot of good understanding of the depth of tax planning that we have now at our fingertips moving forward. And again, I said it before and I'll say it again. It's one of the biggest parts of the tax bill. Let us know if you need us to look into if that changes what your tax planning is. Not much changes. I don't think anything changed with dividends and capital gains. If you're we talked about that 0% tax rate, as Will mentioned that. Yeah. Will, so you'll notice that the joint it's 96,000 this year. So if I'm filing jointly and my income, is less than $96,000, I'm in a 0% cap gains rate. So if I have some securities, some concentrated positions, and I really have a low tax year, I can start unwinding that without any taxes. Okay. Yeah, let's do it. Again, it has to be beneficial to your plan and such. We do that. We help. We have a tax team. We can help look at intra-year tax planning. How much additional breadth do I have before I make these decisions about like Roths and things? Actually, I'm going to talk about Roths in a second. But as far as like capital gains and such, we can see where you stand. All right. This is great. Good. We're going to transition and talk about Roth conversions. We're getting to the tail end of the year. And this is something that's really picking up steam with the clients that I'm supporting. Saw a name there that knows that him and I need to be talking about that sometime soon. But the really big question is do I need to convert or not? And I think it's even more important now to understand that because taxes are lower now in the future, but bracket width is a lot greater. So there's a conundrum there as far as, does it make more sense for me to do Roth conversions now that these tax bill is permanent? Or do I need to rethink this? I have told clients some that it doesn't make sense anymore. And I've told clients, oh, you betcha, it makes a lot more sense now. Sorry for the you betcha. That's my wife's from North Dakota. So every once in a while, my tongue will slip into the North Dakota tongue. All right. But this is a visual that we will put in front of you to give you an understanding of, does this make sense for me to convert to a Roth? Does this benefit me and my tax bill? If I add taxes on in my retirement, this is what this is demonstrating. I am converting up to a certain tax bracket. I'm increasing my taxes today, but effectively I'm lowering that in the future with what I see in the gray. Let's add it up. What makes the most sense? To convert or not to convert? In addition to that, how does this impact what I'm leaving to my heirs? Am I leaving them a lot of pre-tax assets that they'll have to take out over 10 years? That's all taxable at ordinary income. Where are they in their lives when they're going to receive this money? Probably in the highest income years. I've been doing all this tax planning and avoiding, but all of a sudden what's going to happen is, most of this money is going to end up in taxes once it gets in my kids' hands. Well, guess what? Roth conversions don't. If you do the conversions and they have Roth monies, what they receive, they get it all tax-free. So there's a dual benefit that could be possible for doing Roth conversions. It's not only does it help you and your tax situation, but also could possibly the kids. Let us look at it. This is some of the visuals that you're going to get. In this case, a client with future value assets of $34 million, as it stands right now, they're going to leave their kids $6 million of Roth monies. That's excellent. They're also going to leave them close to $12 million of tax deferred assets. I mentioned to you, this money has to be withdrawn in 10 years. So does the Roth. The Roth has to be withdrawn in 10 years, but the Roth's not taxable. And they don't have to take any money out every single year. They can really wait till midnight of December 31st, 10 years after you pass, before they do the withdrawal. And that's not taxable. But these tax deferred assets, they got to keep up with your required distributions. So it's a minimal amount over the 10 years, but by year 10, it's all got to be withdrawn. So in this case, $12 million over a 10-year period, assuming no growth, that's still a lot of money that your kids have to take out every single year. 1.2 million? Whew. What are tax rates going to look like then? If you do those conversions, right? This is, again, example, not everyone's the same, but assuming you did that, okay, now we can assume monies are invested in a Roth. In this client's case, the Roth is not used for cash flow. They have a higher degree of risk for the Roth monies because it is more estate. They may get a little bit more growth associated with that, small change. So the portfolio assets are going to be greater. But the biggest thing, yeah, obviously it's going to help increase the net amount of money that your children receive. So instead of receiving just the what, 6 million? Now these are future value numbers we're talking about, but these are significant numbers, significant tax savings for them. So it's something to look at, if you're not sure, if you haven't had somebody look at Roth conversions, and this is what gets us up in the morning. This gets us excited. All right. So we talked about Roth conversions. Yes, that's going to add some additional income this year, but it could provide substantial tax savings in the future. We're getting to year end, and I was just talking to a client this morning. I'm not sure if she's on, but yeah, it's been a good year. It's really hard to find losses to take. If you have losses, remember you can sell your losses, and you can use that to offset capital gains. So if you have losses that you've taken in previous years, maybe you have some more gains this year because of trading and such, you could use those to offset in this year. But if you do have a capital gain where you sell something at a gain from a non-retirement account, that does create a tax liability. These losses you can use to offset. So as we get towards the end of the year, looking at your lots, if there's any losses that are there and you have some gains, you can certainly use that to offset. Disclaimer: don't go buy it back within 30 days because the IRS don't like that. I can't just sell something and say, you know what, I really like that. I'm just going to book the loss, but I'm going to stay in the security and buy it right back. The IRS is like, no. If you really want to take the loss, you got to say bye for about 30 days. And then afterwards, yeah, you can go ahead and buy it back. So if you really like the position, great, buy it back 31 days later, or buy something similar. I'll probably get some questions about that, how they're different and all that. I get that. But similar examples where you can stay within the same market participation, but be able to book the loss. This is, and this doesn't have to be an end of the year thing, by the way, guys. Like, this is something that I think a lot of people wait to the end of the year to do. But I mean, look at April this year. Look what happened. We had such a huge downturn. Hindsight being 2020, that would have been more the opportunity time to be looking at taking losses. Not right now after the market shot up. How many percent? Really tough. So, making sure you're looking at that all the time. If you do have losses, you can carry forward that every year. So you may have some losses booked on your tax returns. Take a look at your schedules. If you have excess capital losses, you can write off $3,000 against income in any year. That's great. So you can either use that to offset gains, you can use capital losses to offset income, or you can just carry forward it to future years when you may really, really need it. All right, moving along. Will, sorry, gave me a couple of questions. Will just asked, wash sale apply if the security's in your brokerage account? No, it doesn't. The wash, so the question is this wash sales, is that still in fact 401ks? No, because it's not a taxable thing, except you have to worry about round trips within 401ks. Sometimes when you buy a security within the 401k, there's a mutual funds. Mutual fund managers don't like a lot of people buying and selling. So they may, if you start doing it a lot, they may start slapping you on the wrist. Usually they're more longer term. Usually the first time it's a letter, the second time is a warning, and then the third time they won't let you do it anymore. Check with your 401k provider if you're questioning about that. And then we'll also ask about the net investment surtax. Oh yeah. Let me just jump back to that real quick. Where were we? Yeah. So the Obamacare surtax. So this is the greater of your net investment income or your ordinary income. So if once you start getting for joint filers and you get above $250,000, if for a lot of us, that's going to add an additional 3.8% capital gain, which is used to pay for Medicare taxes. So this was the Obamacare surtax. When Obamacare was released, this is one of the ways that they paid for it, which is if your income's above $250,000, there's a good chance your capital gains may be at 3.8% in addition. All right, charitable giving. We mentioned that there's a lot of changes with charitable giving. This year, we itemization may be at our fingertips. Next year, there's that floor that's happening with itemized. So certain things to be mindful of. The first bullet point on the left-hand side says individuals over 70 and a half can transfer $108,000 from their IRAs directly to charity. This is what's called a qualified charitable distribution. This can only be done from individual retirement accounts. This cannot be done from your workplace accounts. That includes 401s, 403bs. The rule is that I can move money out of my IRA. It has to go directly to a charity. It cannot go to my donor advised fund. The charity has to have access to the money immediately. But I can move up to $108,000 this year, and effectively that money's not added to my tax bill at all. I don't get a deduction, but it's not added to my tax bill. Why is it 70 and a half? That's a good question. Because you know what? It used to be 70 and a half back in the day was the required minimum distribution. But the Secure Act changed it to 72. And then the Secure Act 2.0 changed it to 73 or 75, depending upon if you're born before or after 1960. But what they didn't do is change the the qualified charitable date, which was supposed to be tied to the RMD, but they never updated it. So at 70 and a half, you could still do it. So it's something to be thinking about. But definitely if you're over 73, 75, and you are of required distribution age, and you are charitably inclined, this might be something to consider as far as part of your tax plan. Yeah, I think we covered everything on this slide. Unlike distributions, you're not taxed on them. Great, but they're not added. Yep. They can count as your required distribution. Absolutely. So that's really helpful once you're of that age. I mentioned donor advised funds. How does that work? Because I'm getting towards the tail end of this year. I'm thinking about making some donations. And, first of all, how much should I be thinking about to benefit me, right? We can take a look at the tax projections. But, maybe I don't know what I want, what charity I want to give to just yet. I'm not sure. Or, you know what? There's like a lot of charities I want to give to, and I don't want to be filling out forms for 10 different charities. I'd rather just do this electronically. This is where the donor advised fund can really happen. So I can move either cash or non-retirement appreciated securities. So things not in my IRAs, things not in my 401ks, but stock that I own in my normal investment account. And I can take the stock and I can move it into this fund. I do not sell it. It is not a sale. I do not pay any taxes. But I move the stock. In this case, it says appreciated stock, because the market value that I move is what I'm able to use as a possible deduction. Mom, dad left me this stock. Not my parents. I grew up in Baltimore, pretty poor. But let's just say there's this stock that I received when I was really young. And God, if I ever sold it, raked over the coals in taxes. But you know what I could do is I can move some of that stock, not sell it, and get a charitable deduction, not on what the cost basis was, but on the market value. That's pretty sweet. So the money then stays in that donor advised fund. The donor advised fund will sell the stock, and then you can invest that in different of investments, mutual funds, and so forth. And then whenever you're ready, you can go on we use Schwab as our custodian. So the Schwab donor advised fund is what we're familiar with. You can go on Schwab's platform and do a contribution right from your desktop. You can let us know. We can do it for you. But it's just an easy way to gift assets from those securities. So these are really neat ways of planning, especially for those that are charitably inclined, that have, appreciated stock, something to strongly consider as opposed to, writing a check. I think that's a better way. Um, yeah, this kind of covers everything. Yeah. Oh, plan for a charitable legacy. You can keep your name going on. I have a client of mine that has their donor advised fund set to pay out 20 years after they pass. So it provides that charitable legacy to some of their organizations that they support. So they might not be there, but their name's still living on, and financially still supporting on an ongoing basis the causes that they like. I mentioned that there was some bigger tax changes that came from the Secure Act. Secure Act 2.0 was passed in 2022. Made some updates. New rules for those required distributions, 7375. The RMD tax penalty used to be 50% if you didn't take out your RMD in time. Now it's only 25. Honestly, the biggest thing that's really cool is you can roll over funds up to $35,000 from your 529 to your kids' Roth IRA. They need income. It's part of their contributions, but that money can leave their 529 and go to a Roth. That's awesome. And then also your employer, if they allow it, can make your employer contributions as Roth contributions. That would just be taxable to you. Again, what's your financial plan? Does it make sense? Is it an option? Figure it out. But there is an excellent webinar. I always recommend the one Misty put on. It's on our website. Bogart Wealth's got a plethora of learning series on our website. So you haven't checked them out before, please do. Really great speakers. We have a great staff of advisors that do a heck of a job of putting on different webinars just like this. The Secure Act 2.0 that Misty put on is really, really good. So if you haven't looked at it and you want to know, what are some of the things I need to be thinking about, certainly look into that. But yeah, if you're born before 1960, your required distribution is now 73. If you're born 1960 or after, you don't have to take your required distributions till 75. This chart is busy, isn't it? What this is really just trying to highlight is how much is out there when it comes to estate planning and how rules have changed based off of when did the decedent pass. What's the rules for beneficiaries? I wouldn't expect any clients to be an expert. This is what we look at. This is how we help support. How does all these things factor into your plan, or how's it going to factor into the kids' plans? Because it's changed, right? I mean, there's a lot that changed in 2020 with how beneficiaries inherit retirement assets. Remember, it used to be off of their lifetime, off of the individual's lifetime that receives the funds. Now it has to be withdrawn in 10 years. So again, how's that all fit in? What should you be thinking about if you inherit that money? How does that fit into your plan, or vice versa? If your kids are going to receive it, how's it fit into their plan? That's what we do, looking to maximize intergenerational wealth. Okay, home stretch. What's 2026 and beyond going to bring? I tell you, number one, financial plan review. If you're a client of ours, it's our commitment to do an annual plan review with you, looking at taxes, looking at cash flow, making sure your investment strategies align with your strategy. That's really what's allowed us to grow so well, along with understanding and having such a strong partnership with a few really good companies that are out there. 2026 tax brackets, retirement savings. They're releasing that slowly. Basically, you're looking at a small increase on the tax brackets. Nothing sizable, nothing seismic. Now that we know that the extensions are permanent. Estate plan reviews, absolutely. I think moving forward too, you're going to see from your Bogart advisor some enhancement on the estate planning front. So we certainly look forward to that as another way of helping to integrate a more deeper, robust financial plan. So I'm excited about that. And then what's coming out of Washington in 2026? Quite frankly, probably not a lot. I mean, the tax bill was the Republicans' major accomplishment. You're heading up into midterms. Right now, they're still dealing with a government shutdown. We don't think that you're going to see very much come out as far as policy-wise out of DC regarding taxes. That big lift has already been done. Certainly, we're monitoring tariffs and the impact towards that and how it's going to impact consumers. So far, early indications in Q3 earnings are pretty strong, so it doesn't seem like it's factoring in that much. But again, that can still be a slow drip, as Alex mentioned on our latest market call. So with midterms coming up, probably not much that we're seeing here. What is retirement RBD? Are we talking on or after retirement benefit date? No, it's basically the year that you had to take required distributions. And then can you show the slide again on what okay, same thing. Yeah. So the RBD is based off of, did they have to start taking required distributions yet? Based off of when they had to. So the laws have changed, timeframes have changed. Basically, how they start taking required distributions or how they not, before or after. If you need us to do a review of how this all works, this is what we do. We're certified financial planners that you're going to be working with, working on understanding the company benefits, how it integrates with taxes, investment strategies, and the overall plan. It's what we do. And I'm kind of biased, but I think we do a pretty good job at it. So let us know. That's what we do, is that one-on-one financial strategy sessions. Happy to look at a deeper dive into your situation, how we can help. We're located up here in McLean, Virginia. That's where our headquarters are. And then down at Houston and Woodlands, which I'm not sure if there's anyone that was here at the dinner that we did at the Woodlands the other night, but that was fun. We had a really good time there. So thank you if you attended. That was really welcoming. So thanks, guys. I really appreciate you being here. We took the hour. Okay, that's what we did. That's great. QR code here. You can scan it. It gives us information to contact you, learn more about Bogart Wealth. So again, I appreciate you guys taking the time, enjoying your lunch with me, and all the best to you and you and your family as we go on. And let us know how we can help, guys. Thanks.